61,000 foreclosures hit in the last 90 days. Mortgage delinquencies are rising fast, and this is just the beginning. Today on the Housing Nerd, I'm breaking down the latest info on mortgage delinquencies and foreclosures. We're going to look at the trends and what this means for the housing market as we move through 2025 and even into 2026. We're also going to talk about what can be done to solve this problem, and will the government continue to extend and pretend and keep people artificially in their homes that should be moving to foreclosure? And finally, you don't want to miss this. At the end of the video, I'm going to show you how I look for foreclosed properties and give you some tips and tactics on how you could do the same thing. Hey, if you're new to my channel, welcome. My name is Jason Ferrier. I've been a realtor and investor in Central Ohio for the last 7.5 years. I welcome you to the Housing Nerd channel. And if you came to my channel hoping I would tell you that you should buy a home like a typical realtor would, you came to the wrong channel. Not going to do that. I'm also not going to tell you that you should not buy a property and that now the housing market has never been so toxic. Not what I'm going to tell you either. My job is to present the data to you so you can make a more informed decision. Okay, let's get started. Now, for this video, we're going to look at two articles from HousingWire.com. I really want you to pay attention to the data behind the scenes here, because the underlying data for the mortgages and foreclosures we're going to look at today definitely sends some warning signs in my brain. When I look at it, I'm like, wow, there are changes happening right now in the housing market that could affect things significantly moving forward in 2025 and beyond. And the links for these articles are in the description below. So the article is called Mortgage Delinquencies Rise Slightly in Q1. Foreclosure inventory increased across the conventional FHA and VA loan categories. So they say the delinquency rate for U.S. mortgages rose slightly in the first quarter of 2025. This was partially driven by an uptick in conventional loan delinquencies and rising foreclosure inventory, particularly among loans backed by the U.S. Department of Veteran Affairs. We're going to get to more of that info in a minute about how all of a sudden there are foreclosures with VA loans. You'll see why in a minute. The Mortgage Bankers Association, or MBA, reported Tuesday that the seasonally adjusted delinquency rate for mortgages on 1 to 4 unit properties increased to 4.04% of outstanding loans in the first quarter. First quarter, I think the S is a mistake. That's up from 6 basis points from the prior quarter and 10 basis points higher than the same period last year. So there's no doubt delinquencies and foreclosures, those are rising overall. The percentage of loans entering foreclosure also edged higher, rising by 5 basis points to represent 0.2% of outstanding loans during the first quarter. This next part you got to pay attention to. Foreclosure inventories increased across all 3 loan types, and in particular for VA loans. Despite certain segments of borrowers having difficulty making their mortgage payments, the overall national delinquency and foreclosure rate remain below historical averages for now. Their narrative is definitely changing. And it's true. When you look at this chart here in a minute, I'm going to show you on foreclosures and delinquencies, you're going to see overall doesn't look like that much pain in the market. But when you start to look closer at what's really happening behind these numbers, you can see that there are definitely warning signs and pain growing. Hey, quick break from today's video to remind you, hit the like button on the video if you're getting any value. And I'm nearly at 4,000 subscribers, so help me out to get to that 4,000. Subscribe if you haven't already. Okay, back to today's video. Now, remember how they mentioned VA loans? That was a particular problem. Now they're going to explain why. VA loans saw the sharpest gain in foreclosure activity. The percentage of VA loans in foreclosure rose to 0.84% for a minute. Just think about that. The percentage of VA loans in foreclosure rose to 0.84, nearly 1%, approaching 1% of all VA loans, all VA mortgages are actually in foreclosure. Now, if you go back up to the top, it says that just 0.2% of outstanding loans are in foreclosure. So you've got, what is that? That's like an explosion of VA loans in foreclosure compared to all loans. So that's definitely something to watch out for, our VA loan. The increase from the previous quarters marks the largest quarterly change recorded for the VA foreclosure inventory rate since the inception of MBA's survey in 1979. So comment below. I want to know from you. Do you think that the VA foreclosures will continue to increase? Do you know somebody with a VA loan who's having a problem paying their mortgage? These folks gave their life and limb for our country, and it's really sad to see more and more VA foreclosures, but comment below and tell me what you think. And by the way, if you're a veteran, thank you for your service. So why are we seeing such a dramatic rise in VA foreclosures? This is why. A voluntary VA foreclosure moratorium was in effect through the end of 2024 to allow time to implement the Veteran Affairs Servicing Purchase Program. That program has since ended without a replacement loss mitigation option approved by Congress. Further increase in the foreclosure rate could result if economic conditions worsen and loan workout options are unavailable. So one of the things that really you don't see in the media much, and certainly politicians, government officials are not talking about this, is the moratoriums that have been put in place ever since COVID started. So there were a lot of loss mitigation measures, moratoriums, and just different types of programs available for borrowers to not make mortgage payments, essentially. There are upwards of 500,000 borrowers that were not making their mortgage payments, and there's no foreclosure coming for them. Why? Well, the government just allows them to not make the payments and essentially makes the payment for them, but puts it on the back end of their loan. And that can happen for 6 months, 12 months, 18 months, sometimes 2 years. I mean, there are people in their houses right now that haven't made mortgage payments in 2 years, but they haven't been foreclosed on. Now, some of these programs are important because during COVID, a lot of people lost their job or were unemployed. And so to have some bit of help for homeowners, I feel like makes sense. However, those programs never really ended and they just kept extending them. Now, the good news is for a lot of us, and probably for the long-term health of the housing market, is that these programs are ending. Now the government has decided to end the FHA loss mitigation program early. It was supposed to end next year in February of 2026, but now it's going to end in the fall, in October of 2025. And so I want to know what you think about these moratoriums and extending and pretending, kicking the can down the road. And also I want to know what you think about the FHA loss mitigation program ending early. So please comment below. However, based on a recent Housing Nerd survey, this is what you think. About 9 days ago, I asked y'all, should the government keep bailing out mortgages to help struggling homeowners or let the market crash to lower home prices? 90% of you said, let the market crash. Only 10% said, help struggling homeowners. And make no mistake, folks, what the government does with these backlogs of foreclosures and delinquencies, how they handle this is going to drastically shape the housing market moving forward. It's not an easy situation, right? They can kick people out of their homes who have thought that, they could extend and pretend forever and, the government can get tough and kick them out, or they can extend and pretend further, or maybe something in the middle. Again, I want to know what you think. But let's continue with the article. Now we're going to break down delinquencies by stage and loan type. The 30-day delinquency rate rose 11 basis points to 2.14%. The 60-day delinquency rate declined by 3 basis points to 0.73%. And the 90-day delinquency rate declined 2 basis points to 1.17%. And the rise or the fall in these stats right now, that's from last quarter to this quarter. So we're talking quarter 4 of 2024 to quarter 1 of 2025. But look at this. By loan type, conventional loans saw their seasonally adjusted delinquency rate rise 8 basis points to 2.7%. FHA loans posted a decline of 41 basis points to 10.62%. And VA loans saw a decrease of 7 basis points to 4.63%. What stands out to you? Well, this one stands out to me, folks. The FHA loans being 10.62% delinquent. That means out of all the FHA loans out there, if you had 10 FHA loan borrowers or buyers in your neighborhood, 1 out of 10 are delinquent on their mortgage. Comment below. Let me know if you're surprised by that or not. And that rise or fall is based on quarter 1 versus quarter 4. But when you look at a year-over-year basis, this is what you see. Delinquencies increased 8 basis points for conventional loans, increased 23 basis points for FHA loans, but decreased just 3 basis points for VA loans. So on a year-over-year basis, there is a definite change in delinquencies. So now they talk about foreclosures, but I'm going to save that for the next segment because I want to continue on the delinquency rates. Because remember, you got to be delinquent in order to get foreclosed on. Now, the serious delinquency rate, loans 90 or more days past due or already in foreclosure, stood at 1.63%. This represents a 5 basis point decrease from Q4 of 2024, but a 19 basis point increase from a year earlier. Conventional loans saw a 3 basis point quarterly decline, but a 5 basis point annual increase in serious delinquencies. FHA loans dropped 14 basis points from last quarter, but were up, are you ready for this? 80 basis points year over year. That's a big increase. VA loans declined 7 basis points from the prior quarter and increased 50 basis points from a year ago. So, see what I mean? They lead with the fact that mortgage delinquencies are actually dropping when you look quarter over quarter. But when you really examine the data, year over year, delinquencies are definitely up and serious delinquencies are through the roof compared to last year. Then they give us the 5 states that experienced the most significant annual increase in overall mortgage delinquency. And that is Florida up 46 basis points, South Carolina up 26 basis points, Georgia 25, Delaware 25, and Wyoming 24 basis points. Now we talked about delinquencies. So basically we know all stages of loans are increasing with overall delinquencies, and some segments like VA and FHA have a lot more pain. But why do we see a rise with FHA loans in particular? Well, one reason could be that FHA borrowers typically are the most risky. Some people are calling that the new subprime because the overall credit score requirements and debt to income ratio requirements for FHA are far more lenient than they are for conventional loans. And not only that, but down payment requirements are sometimes as much as zero. You can sometimes get a grant to actually pay for your down payment. And so there's very little skin in the game for the borrower. And because of that, they are more risky. But tell me what you think. Do you think FHA loans are now the new subprime? Now we're going to move to another article from HousingWire. This one is called Why Foreclosures Are Still Below Pre-Pandemic Levels. According to the most recent credit data from the New York Fed, foreclosure data for the housing market is still below 2019 levels. Although foreclosure rates rose in the last quarter, were far from the stressful levels we saw during the run-up to the housing bubble crash in 2008. You'll see that in a minute when we look at some charts. Credit data in general doesn't look great when accounting for credit card debt, auto loans, and student loan debt. All have had an increase in their percentage on 90-day lates. But in general term, homeowners' financials are solid as a rock. So what do you think of that last statement? I told you they're going to be bullish. Do you think the financials of homeowners are solid as a rock? Comment below, I want to know. The chart below illustrates the foreclosure data showed little stress for many years prior to the onset of COVID. And it continued to perform well since then. Post-COVID, for many years, levels were abnormally low, and we should have returned to pre-pandemic levels by now, even with foreclosure prevention programs in place. To me, that's complete hogwash. Like, give me a break. If the I can't even say it, it's so crazy. The foreclosures were being suppressed or are being suppressed right now. So why would we return to normal levels if these extend and pretend programs were in place? I mean, obviously that's what's keeping them at bay. Late cycle lending risk is always a factor in every economic cycle we experience in the housing market. However, as shown below, the housing credit situation in 2008 had already begun to deteriorate years before the Great Recession started. In contrast, the current state of the housing market appears to be much healthier when compared to credit cards, auto loans, and student loan debt. So this chart shows us foreclosures and new bankruptcies are still below pre-pandemic levels. Foreclosures did rise in the last quarter. They put that in smaller writing and not bold because why? They don't want to, I guess, alarm anybody. But the data is the data. Let's go back to 2008 and look at the foreclosures. And this is pretty crazy stuff, right? Like what they're saying is leading up to the GFC, the health of the consumer was horrible. And for households, it was really bad. And you could see back bankruptcies, Q4 of 2005, we had 948,000 bankruptcies in one quarter, right? Insane. And they're saying that stress led to more and more foreclosures, not just bankruptcies. In 2006, Q1, we had 172,000 foreclosures in just one quarter. And that steadily increased. You know, it went up and down somewhat, but overall steadily increased all the way to the height. In 2009, quarter two 2009, we had 566,000 homes in foreclosure. 566,000 in one quarter. And then that dropped and dropped and dropped to where we are right now, which is 61,000 homes in the foreclosure process in quarter one of 2025. But if you look at that number and kind of go across, right? If I kind of go across here, I can see that quarter one of 2020, we had 74,000 homes in foreclosure. Then it dropped substantially. Why? Because of the moratoriums and the government programs that were put in place, not because the consumer was that much healthier. So no doubt we are very close to pre-pandemic levels of foreclosures. Now they're going to go into why the health of the homeowner is so awesome. Again, comment and tell me how healthy you think the average homeowner is with their finances right now. One of the things I want you to pay attention to as review this next set of data is the fact that they leave out one aspect of homeowner budgets that have recently come to light. I'm wondering if you can guess what that is. Comment below if you can guess. But I noticed it was conveniently left out of this article. The FICO score data for housing has been impressive since the qualified mortgage laws were implemented after 2010. The majority of people in the country are obtaining 30-year fixed loans. That's true, which provides stable debt costs. With rising wages, cash flow for most homeowners has been stable for the past 14 years. So I agree with him that the qualified mortgage program has allowed many homeowners to have fixed rate debt, which is really important when it comes to real estate most of the time, especially with your primary residence. However, did you know that adjustable rate mortgages are making a comeback and now represent about 15% of all origination? At the height of the housing crash, we were around 45 to 50% of all originations were ARMs or adjustable rate mortgages. So while fixed debt has definitely dominated home ownership recently, make no mistake that ARMs have made a comeback as home prices have stayed high, mortgage payments are high, and homeowners are looking for a way to maybe mitigate those high payments with a exotic loan like an adjustable rate mortgage. And comment below, I want to know from you, do you think adjustable rate mortgages are a good idea? Would you use an adjustable rate mortgage? Let me know in the comments below. When I consider why the U.S. has avoided a recession since 2010, excluding the impact of COVID, I believe the QM or qualified mortgage law and the 2005 bankruptcy reform law have played significant roles. These laws help moderate household credit expansion, preventing consumers from over-leveraging on a large scale. They have truly been the unsung heroes of the U.S. economy in this century. I keep asking you, but I want to know what you think about some of these statements. Do you think they're the unsung heroes of the U.S. economy in the century? And do you think these laws have prevented homeowners from over-leveraging themselves? I'm not sure I agree with that, but I'd like to hear from you. And here they show a chart of the high credit scores dominating mortgages. The majority of FICO score data for the 14 years has been 720 or above. There's no doubt, like when you look, especially 2019, 2020, 21, 22 through COVID, look at the dominance of 760 credit scores. Massive. Now, if you continue down that path, so it looks like that high credit scores continue to dominate most mortgage purchases. Why? Well, they changed the rules with qualifying for mortgages. Now there's a qualification you have to go through. You can't do stated income. You can't just do like exotic loans that are negatively amortizing, and you can't do, interest-only loans on 30-year mortgages. So overall, mortgages, I would definitely agree, are more healthy than they have been in recent years. While there are signs of credit stress in credit cards, auto loans, and now student loan debt showing up again in the delinquency data, homeowners, at least on paper, appear to be in a stable position overall. So I asked you earlier what they left out of their data analysis, and they did mention it. I'm sure you guessed it, student loan debt. That's something you got to pay attention to. So check this out. According to educationdata.org, 37% of first-time home buyers have student loan debt. 37%. Now, we all know what's going on with student loans, right? This isn't a student loan channel, and it's not an overall personal finance channel. But there's no doubt that student loan borrowers are feeling the crunch right now. Many of them haven't had to pay their student loans for the last 5 years. So picture this. Let's pretend I'm an FHA buyer, and I decide to buy a home 3 years ago when I didn't have to make my student loan payment. That sounds great. Then all of a sudden the government comes knocking and says, guess what, Jason, you have to start making your student loan payment. It could be $500, could be $1,000, could be $1,500 now that I'm forced to pay, and you can't declare bankruptcy and get rid of the student loan. So that has to put pressure on these FHA borrowers. And I think we're going to see a lot more stress because of the student loans. Unfortunately, when the next recession occurs, renter households are likely to bear the brunt of the impact. On the other hand, homeowners not only tend to have strong credit scores, but they also possess a significant amount of equity in their homes. They're right about this. Equity is insane right now in properties. So check this out. The Great American Cushion, they call it. Kind of a catchy name. 82% of borrowers have at least 30% equity in their home. So this chart shows us the loan to value. In other words, how much debt do they have tied to their house? And these are just borrowers. This doesn't count the people that have the house paid off. So this means 72% of borrowers have less than 60% loan to value, or in other words, greater than 40% of equity in their properties. And then you can see 10% of borrowers or 11% have between 61 and 70% loan to value. In other words, basically 40 to 30% equity, and then so on. So there's no doubt that there is a massive amount of equity in the system. I think when I read the stat last time, the average homeowner in the US has about 300 grand in equity in their house. The article concludes with, we monitor all credit housing data and new listings closely to keep everyone informed about any potential housing credit stress. During the housing bubble crash years, we had near 15 million loans in delinquency, 15 million, insane, which meant we were about to have a lot of foreclosures happening. And as home prices were falling, a lot of home equity was lost. Now, most homeowners have a ton of equity to sell, and almost 40% of homes in America don't even have a mortgage. That's true. Currently, new listings are trending back to normal levels, similar to those we observed during COVID-19, where seasonal peaks range from 80,000 to 110,000 per week. During the years of the housing bubble crash, this index was operating between 250 and 400,000 listings per week for several years. Now that the credit markets have improved, we do not see any stress reflected in the data. Look at that last line. Now that the credit markets have improved, we do not see any stress reflected in the data. I think specifically they're talking about new listings, not necessarily delinquency stuff we looked at before. And I agree with them on the new listings. Right now, we've got basically 80 to 110,000 new listings per week. That seems to make sense overall. Okay, so that's mortgage delinquencies, but let's go back and look at some foreclosure data. And when they say foreclosure inventory, that means a property that's in some stage of foreclosure, whether it be an early stage or a late stage. So back during the GFC, look at the rate of foreclosure. I mean, it was like through the roof. Specifically, conventional led the way with nearly 5% of all loans at some stage of the foreclosure process. So this chart represents the percentage of all loans that are in foreclosure at some point in the process. But look back at the GFC around 2011 or so, because we saw mortgage delinquencies skyrocket, right? They had said there's about 15 million mortgages that were delinquent during the worst time leading up to the foreclosure crisis of the GFC, because you've got to have all that delinquency come in, then you'll see foreclosures. At the height of the GFC, it was nearly 5% of all mortgages had a foreclosure on them. So you can see back during the GFC, nearly 5% of all conventional loans had a foreclosure. If you look at all loans combined, the whole shooting match, over 4.5% of all loans in some stage of foreclosure during the GFC. Just insane, right? FHA had dropped. That was actually a lot less than conventional. Most people wouldn't guess that. And VA was lower. But guess what happened? Over the last few years, the government has made it easier for FHA borrowers to actually buy homes and qualify. They've lowered the qualification requirements. Because of that, guess what? FHA loans have become much more risky. And you can see it in the data. Look at the blue line, which is FHA. Look at it kind of teeter around. It continues to go down, but oops, it spiked big time in 2022 and stayed high, dropped somewhat, but now it's going back up. So it shows that there's definite pain with the FHA foreclosures. And look at VA, straight through the roof. Why? Because that VA moratorium ended. And all loans are relatively still low, obviously, and conventional loans are performing the best. So overall, I don't see foreclosures flooding the market anytime soon. However, I would keep my eyes on this. And that brings me to the last stage of this video. We're going to look at how to find foreclosures, or at least how I look for them. Depending on where you live in the US, one of the easiest ways to find a foreclosed property is go to your local sheriff's sale website. A lot of counties, like the county I live in here in Ohio, they have a page dedicated just to foreclosed properties and auctions. And so all these properties right here are available for sale. All these properties are being auctioned for foreclosure, and all these properties are being auctioned. And so these foreclosures can be purchased, and usually they're bid online. So like this one, for instance, was sold at foreclosure. They give you the case number, they give you the address, then they give you a link to the actual parcel itself that you can look at from the auditor site. They show you the appraised amount. They show you the sale date. It actually sold 1/9/2025. Then they even show you who bought it. This person bought it for $150,000. Now, is the property worth that? I don't know. I didn't look at this one, but I do keep my eye on this website often because they're local foreclosures. Again, depending on what county, what state you live in, they may have this, they may not, they may have something better. And by the way, something the article left out that I just thought of were property taxes and insurance. They didn't even mention those things. Those are killing homeowners right now, people who even don't have mortgages. And the reason I mention that is this screen right here. I'm looking now at all the foreclosures from last year in my county. And I want you to pay attention to this. I have them sorted by sale type. You can see there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. There were 23 foreclosure sales in my county, all from taxes, just taxes, not the mortgage. And that has gone up a lot. There are mortgage foreclosures that are happening, but certainly tax foreclosures as well. Anyway, the article missed that. I thought it was important to point it out. So this is where you can go, or a website like this, depending on where you live, to look for a foreclosure. Now, another way to look for foreclosures is to use a software that you actually pay for. There are probably free softwares out there as well. This is a software I use called PropStream. The link's in my description below for that software. And it's not cheap. It's like $110 a month, but I use it a lot. And you can go into this website once you subscribe, and I think they have a trial, and you could go in and actually find foreclosed properties by city, by county, by zip code, even if you live in a non-disclosure state. So these are all the foreclosures for Columbus, Ohio, the big city near where I live. And you can see there's 330 foreclosures right now, pre-foreclosures. So people that have just had the foreclosure notice filed on their property. And usually that's a good time to actually get a hold of them because it hasn't gone to the bank yet. It hasn't actually gone to auction. I mean, here's one right here, 2814 Stonehenge Drive in Columbus. Looks like it's a condo. Here's what's crazy. This particular foreclosure is actually from the association. This is a homeowner association lien and foreclosure. That's right. They can foreclose on your home if you don't pay the association dues, or if there's a fine from the association and you just not pay them. They can actually file a lien and foreclose on your property. Here's one, 3626 Medina Avenue in Columbus. And it looks like this is a foreclosure. You can see here the pre-foreclosure details. It actually shows you the foreclosure stage, and then it shows you the lender name. It even shows you when they actually recorded the foreclosure and filed it, 10/15/2023. The original loan amount, $90,361. Recording date, 10/20/2016. And by using this software, you can actually find out who owns the property and maybe even where they live. A lot of times, like here, it gives their address, their mailing address, which happens to be the same house. And it obviously gives you the owner information. So it's something that you can use to reach out to them to find out, hey, are they interested in selling the house before it goes to auction? I've purchased many properties doing this. Now, regardless how you identify a foreclosure, a lot of people ask me, okay, now what do I do? Like, how do I make sure I don't get completely, hosed in the deal? Well, you have to follow a few steps. They're pretty simple, but they're absolutely mandatory. Number one, you want to set the right expectation. Realize that if it's a foreclosed property, many times they're in serious disrepair. They need a lot of work. That makes sense, right? If somebody's not paying their mortgage, how in the world are they going to pay the upkeep on the property, right? So set your expectation correctly and don't expect you're going to walk into the home when you actually buy it, because guess what? Many of these foreclosures, unless you talk to someone off market before it goes to auction. If it's at auction already, most of these foreclosures, at least a lot of them anyway, can't be viewed. You can't walk through them. You're buying it sight unseen. Some of them with foreclosures are actually listed on the MLS, and they allow you to actually maybe work with an agent to go in and actually see the property before you bid on it. But realize you're going to be competing with a lot of other people. But in any case, if you can walk through the property prior to, do it. If you can bring a contractor with you to understand the repair costs, do that. And you certainly want to inspect the house as much as possible, crawl inside and outside of it, take as much time as you can to inspect every aspect of that foreclosed property, because you don't want to get hit with a hidden gremlin that bites you in the rear after you actually purchase it. Now, the other thing is you want to make sure you run a title search on the property before you make a bid, so you know what's happening with the title. And when you buy the property, make sure you get title insurance. And overall, you probably want to consult an attorney if you don't know what you're doing and you're kind of early in the foreclosure game and you don't have a lot of experience in doing that, which makes sense. You definitely want to consult an attorney who can help you understand, hey, what's happened? What are the risks with the title? What are the risks in buying the property? Because if you're getting a deal, there always are more risks than when you pay retail for a house on the MLS or off of Zillow. Now, there are other websites out there too. You can research websites that actually only allow owner occupants to bid on properties. You can research properties that came from just FHA mortgages, and they only want owner occupants to live there. And so only owner occupants can bid on those properties. Those websites exist if you just do some quick work on Google. And don't think you have to have cash to buy a foreclosure or buy something at auction. Talk to lenders. Really do some research. It's important to network with lenders, investors, even realtors in your local market, because there are probably certain types of auctions and lending programs that can allow you to use a loan, even an FHA loan, with an FHA repair loan to actually buy the auction, fix it up, and have a ton of equity at the end of the day versus buying something retail. Remember, to get a discount, you got to do work others are not willing to do. Now, if you want more data on the housing market, you want to stay up on the latest trends, I'd suggest you check out another one of my videos right here, up here.